Mastering Financial Freedom Introduction. In a world where financial stress can often feel like a constant companion, the dream of financial freedom remains one of the most sought-after goals. It represents not just the ability to live comfortably, but the freedom to live life on your own terms, free from debt, free from financial worries, and with the opportunity to build a future that aligns with your values and aspirations. However, the path to financial freedom is not a simple one. It's not about luck or waiting for the right moment. It's about understanding wealth, building strategies, cultivating the right mindset, and taking consistent, deliberate action. The goal of this book is to equip you with the tools, knowledge, and inspiration to master your finances and achieve lasting financial independence. Throughout these pages, we will explore essential wealth building strategies, from mastering the fundamentals of budgeting and investing to understanding the power of passive income and entrepreneurship. You'll learn how to manage debt, build your credit score, and develop a mindset that fosters abundance. Whether you're just starting your financial journey or looking to enhance your current approach, this book is your guide to building a prosperous and secure future. Financial freedom isn't just a dream. It's a realistic, achievable goal for anyone who is willing to take the necessary steps. By the end of this book, you'll have a clear roadmap to guide you toward your financial goals, equipped with the strategies, knowledge, and confidence to create the financial future you deserve. It's time to take control of your financial destiny. Let's begin the journey toward mastering financial freedom. Chapter 1: The Mindset of Financial Success. When it comes to building wealth, the most important factor isn't your income, your education, or even your skills. It's your mindset. The way you think about money, wealth, and success will shape the decisions you make, the actions you take, and ultimately, your financial outcomes. A mindset rooted in growth, discipline, and abundance is the foundation upon which all other wealth building strategies will thrive. The power of your thoughts. Your thoughts shape your reality. If you constantly worry about scarcity and struggle, your actions will often align with that mindset. You may avoid taking calculated risks or be hesitant to invest in opportunities that could help you build wealth. On the other hand, when you cultivate a mindset of abundance and growth, you open yourself up to opportunities that others may overlook. A successful financial mindset is centered on the belief that wealth is available to everyone. It's not about being in the right place at the right time or waiting for a big break. It's about creating and seizing opportunities, regardless of your circumstances. Successful individuals understand that they can control their financial destiny through conscious choices and deliberate actions. The growth mindset, embracing learning and adaptability. At the heart of financial success lies a growth mindset. Coined by psychologist Carol Dweck, the growth mindset revolves around the belief that abilities and intelligence can be developed through dedication and hard work. This belief is crucial for your financial journey. People with a growth mindset don't see challenges as obstacles. They see them as opportunities to learn and grow. When facing financial setbacks, whether that's a missed investment, a failed business idea, or unexpected expenses, they don't give up. Instead, they reflect, adapt, and find ways to improve. This mindset is what separates those who achieve financial freedom from those who remain stuck. By adopting a growth mindset, you'll approach financial learning as an ongoing process rather than a destination. Whether it's reading books, attending workshops, or learning from your financial mistakes, you'll continuously seek out knowledge that helps you make smarter financial decisions. Setting clear financial goals. The journey to financial freedom begins with setting clear, achievable goals. Without clear goals, it's easy to drift through life without any direction. A person who is unsure of what they want financially is likely to take the necessary steps to achieve it. To set meaningful financial goals, ask yourself questions like, what does financial freedom look like for me? How much money do I need to achieve that vision? When do I want to reach my financial goals, and why? What steps can I take right now to move closer to my goals? The most successful people don't leave their financial future to chance. They create a roadmap of where they want to go and break down their long-term vision into actionable steps. The importance of discipline and consistency. Financial success isn't about making one big, lucky decision. It's about making small, smart decisions consistently over time. Discipline and consistency are your greatest allies in wealth building. It's the ability to prioritize long-term rewards over short-term gratification that sets the wealthy apart from the rest. Discipline in your financial habits means sticking to your budget, resisting impulsive purchases, and making smart investments. Over and over again. Whether it's saving a portion of your income every month or investing consistently in the stock market. Discipline is key to building wealth. Consistency, on the other hand, is the ability to stay on course even when things aren't going perfectly. It's about showing up for your financial goals day after day, week after week, regardless of the challenges. The compound effect, where small, consistent actions lead to big results over time, applies to both saving and investing. The more consistent you are, the more your wealth will grow. Cultivating an abundance mentality. An abundance mentality is the belief that there is enough wealth and success to go around for everyone. People with an abundance mindset focus on creating value, building relationships, and giving back. They believe that the universe rewards those who put in the work and stay focused on long-term success. On the flip side, a scarcity mindset is one of fear, competition, and lack. People with a scarcity mentality believe that there is a limited amount of wealth and success, so they must compete for their piece of the pie. This mindset leads to a constant feeling of stress and inadequacy, making it harder to make sound financial decisions. Cultivating an abundance mindset involves focusing on possibilities, seeking opportunities, and recognizing the value of collaboration over competition. It's about seeing wealth building as an ongoing journey where there's room for everyone to succeed. Overcoming self-doubt and financial fears. One of the most significant barriers to financial success is the fear of failure. Many people fear taking the first step toward financial independence because they worry they'll make a mistake or lose money. However, it's important to understand that mistakes are a natural part of the learning process, especially in financial matters. To overcome self-doubt, start by recognizing that your financial mistakes don't define you. Rather, they provide valuable lessons that can propel you forward. Understand that taking calculated risks is part of the wealth building process, and every successful person has faced their own share of setbacks. Building financial confidence requires small, consistent actions. Whether it's saving a little more each month, making your first investment, or seeking advice from others, each step will increase your confidence and help you push past your fears. Developing a positive relationship with money. Finally, a key component of the financial mindset is developing a healthy, positive relationship with money. Money is simply a tool that can be used to create the life you want. When you view money as a means to an end, rather than the end itself, you'll be able to make better, more purposeful financial decisions. A positive relationship with money involves recognizing its potential to bring freedom, security, and opportunities. It's not about worshiping money, but about using it responsibly to enhance your life and the lives of others. When you see money as a tool to create value, you're more likely to make decisions that will lead to wealth in the long run. Conclusion: The mindset of financial success is the bedrock upon which all wealth-building strategies are built. By adopting a growth mindset, setting clear financial goals, embracing discipline and consistency, cultivating an abundance mentality, and overcoming your fears, you will be well on your way to mastering your finances. Remember, financial freedom isn't a destination. It's a journey that begins with the right mindset. As you progress on this journey, continue to nurture and strengthen your mindset. The right way of thinking will empower you to take the necessary steps, make smarter decisions, and ultimately achieve the financial success you desire. Chapter 2: The Power of Financial Education. Financial education is the cornerstone of wealth building. It's not just about knowing how to balance your checkbook or how to avoid debt. It's about understanding the broader financial landscape and how to use your knowledge to make informed decisions that build long-term wealth. The more financially educated you are, the better equipped you'll be to navigate the complex world of money, investments, and wealth creation. In this chapter, we will explore the importance of financial education, the foundational concepts you need to grasp, and practical steps to continually educate yourself and apply what you've learned. The importance of financial literacy. When it comes to money, many people feel overwhelmed or confused. In fact, a large portion of society never receives formal education about personal finance. As a result, they make uninformed decisions, miss opportunities, and, in some cases, fall into debt traps. This lack of financial literacy can hinder people from reaching their full potential financially. Financial literacy isn't just for people working in finance. It's a life skill that everyone can benefit from. Understanding the basics of money management, investing, and financial planning empowers you to make smarter choices, avoid pitfalls, and work toward financial freedom with confidence. In today's world, financial education is more accessible than ever, with countless resources available online. Books, blogs, podcasts, online courses, and videos. There's no reason not to educate yourself on the fundamental principles that drive wealth building. The core concepts of financial education. To truly harness the power of financial education, there are several key concepts you must understand. These concepts serve as the building blocks for your financial journey and will guide your decisions as you work toward financial freedom. 1. Budgeting and money management. One of the first steps to financial success is mastering the art of budgeting. A budget is a financial plan that outlines your income and expenses, helping you allocate your money effectively. Without a clear budget, it's easy to overspend, accumulate unnecessary debt, and lose sight of your financial goals. Key elements to focus on when learning about budgeting include income vs. expenses. Understand where your money is coming from and where it's going. The 50-30-50-20 rule. This popular budgeting method divides your after-tax income into three categories: 50% for necessities, 30% for wants, and 20% for savings and debt repayment. The importance of saving. Learn how to allocate a portion of your income to savings and long-term goals. By gaining a solid understanding of budgeting, you can ensure that your spending aligns with your financial goals and that you're consistently saving and investing for the future. 2. The power of compound interest. Compound interest is a powerful force in wealth building. It's the concept of earning interest, not just on your initial investment, but also on the interest that accumulates over time. This effect accelerates the growth of your wealth, which is why starting to invest early is so important. When you understand compound interest, you begin to see the value of time in your investment strategy. Even small contributions to an investment account, made consistently over time, can result in significant wealth accumulation thanks to the magic of compounding. 3. Credit and debt management. Managing debt and building a strong credit score are critical components of financial education. Debt can be a useful tool when used wisely, but it can also be a major roadblock to financial success if mismanaged. Some important concepts to understand included: good vs. bad debt. Not all debt is created equal. Good debt is used to acquire assets that appreciate in value, such as a mortgage or student loan, while bad debt is used for depreciating assets, such as credit card debt for non-essential purchases. Credit scores. Your credit score reflects your creditworthiness and impacts your ability to borrow money at favorable rates. Understanding how to manage your credit and improve your score is essential for accessing affordable financing. Debt repayment strategies. Learn the best strategies for paying off high-interest debt, such as the avalanche or snowball methods, to free up more money for investing. By mastering debt management, you can minimize the negative impact of debt on your financial future and make it work in your favor when needed. 4. Investing for growth. Investing is one of the most effective ways to grow your wealth over time. The stock market, real estate, and other investment vehicles provide opportunities to build wealth that goes beyond saving alone. However, investing comes with risks, and understanding how to navigate those risks is a key part of financial education. Some essential concepts to grasp when learning about investing include risk vs. reward. Investments come with varying levels of risk. Higher potential returns often come with higher risk. Learning how to balance risk and reward is essential for long-term success. Diversification. Spreading your investments across different asset classes, such as stocks, bonds, and real estate helps reduce risk and ensures that you're not too reliant on one type of investment. Long-term investing. Successful investing is typically a long-term endeavor. Understanding the importance of patience and holding investments through market fluctuations is key to seeing significant returns. By educating yourself about investing, you can begin to make decisions that will build your wealth over time and set you on the path to financial freedom. 5. Taxes and wealth preservation. Taxes are an unavoidable part of life, but understanding how taxes work and how to minimize your tax liability is essential for wealth building. Many people lose a significant portion of their income through taxes, simply because they don't understand how to take advantage of tax-saving strategies. Key concepts to focus on included tax, advantaged accounts. Learn about accounts like IRAs, 401ks, and HSAs, which allow you to save money tax-deferred or tax-free. Tax deductions and credits. Understand which expenses can be deducted from your taxable income to reduce your overall tax liability. Tax-efficient investing. Certain investment strategies can help reduce the amount of taxes you pay on your investments. Learning about capital gains taxes, dividends. In tax, loss harvesting can have a major impact on your wealth accumulation. By understanding taxes and wealth preservation strategies, you can keep more of your hard-earned money working for you. Practical steps to becoming financially educated. Financial education is an ongoing process. The more you learn, the more confident and capable you'll become in managing your money. Here are some practical steps to continue your education. Read books and articles. There are countless books, blogs, and articles that cover personal finance topics. Commit to reading regularly and expanding your knowledge. Take online courses. Many reputable websites offer free or affordable courses on topics such as investing, budgeting, and entrepreneurship. Follow financial experts, listen to podcasts, watch YouTube videos, and follow social media accounts of financial experts who can provide valuable insights and tips. Attend workshops and seminars. Look for local or virtual workshops on finance, investing, and wealth building. Learn from experience. While education is essential, real-life experience is invaluable. Start budgeting, saving, and investing to put your knowledge into practice. Conclusion: financial education is one of the most powerful tools you can use to achieve wealth and financial freedom. By understanding core concepts like budgeting, investing, debt management, and taxes, you'll be able to make informed decisions that move you closer to your financial goals. The more you educate yourself and apply what you've learned, the more you'll build the financial foundation necessary for long-term success. Remember, financial education is a lifelong journey. The more you learn, the better equipped you'll be to navigate the complexities of the financial world and create the life you've always dreamed of. Chapter 3: Creating multiple streams of income. In today's financial landscape, relying on a single source of income is no longer the most secure or effective way to build wealth. While a full-time job or primary business can certainly provide financial stability, it is the creation of multiple streams of income that truly accelerates your journey toward financial freedom. Multiple income streams allow you to diversify your revenue, reduce your financial risks, and create new opportunities for growth. In this chapter, we will explore the importance of creating multiple streams of income, how to identify and build them, and practical strategies for leveraging your time and resources to generate wealth. Why multiple streams of income matter. Relying on one income source is like putting all your eggs in one basket. If that source of income were to dry up due to a job loss, a downturn in your business, or unforeseen circumstances, your entire financial well-being could be at risk. Multiple income streams help safeguard your financial security and provide you with the flexibility to weather unexpected changes in your life. Additionally, multiple income streams accelerate the process of wealth building. Instead of relying solely on your salary or business revenue, you can tap into various avenues that continue to generate money even when you're not actively working. This creates the potential for exponential growth, where your money works for you, while you focus on scaling and expanding your wealth building efforts. Types of income streams. There are generally 3 types of income stream: active, passive, and portfolio. Understanding each type is essential for creating a balanced and diversified approach to wealth building. 1. Active income. Active income is the income that you earn from direct effort. This includes wages from a job, freelance work, consulting, or any other form of income where you actively trade your time and skills for money. While active income can provide a steady flow of cash, it has its limits. Your earning potential is typically tied to how many hours you can work or how much work you can take on. While active income alone may not lead to financial freedom, it can serve as a reliable foundation to fund your other income streams. In the early stages of building wealth, active income can be used to save and invest in other opportunities. 2. Passive income. Passive income is the holy grail of wealth building. It refers to income that requires little to no effort to maintain once it's set up. This type of income allows you to earn money while you sleep, work on other projects, or spend time doing the things you enjoy. Examples of passive income streams include real estate, owning rental properties that generate monthly rental income; dividend stocks, earning regular dividend payments from stocks or mutual funds; royalties, earning royalties from books, music, patents, or other intellectual property; online businesses, running an automated online store or digital products, e.g. e-books, courses, or membership sites; peer-to-peer lending, investing in peer-to-peer lending platforms and earning interest on your loans. Creating passive income is one of the most powerful ways to achieve financial freedom. The beauty of passive income is that it allows you to build wealth without being constantly tied to a time for money exchange. 3. Portfolio income. Portfolio income refers to income generated from investments. This includes earnings from stocks, bonds, mutual funds, index funds, and other forms of investment. The key to portfolio income is that your wealth is growing by putting your money into income-generating assets, and you earn a return on those investments over time. Examples of portfolio income include capital gains, profits earned from selling investments at a higher price than what you paid for them; interest payments, earnings from bonds or other fixed income investments; dividends, earnings from stocks or other investment vehicles that pay out dividends. Unlike active income, portfolio income doesn't require your direct involvement, and once you've built a solid portfolio, it can generate income with minimal effort on your part. Building your multiple income streams. Now that we've outlined the different types of income streams, it's time to look at how you can build them. While it might seem overwhelming to create multiple streams, the key is to start small and gradually expand over time. Here's a step-by-step approach to building your own income streams. 1. Assess your skills, resources, and interests. Before you start building multiple income streams, take an inventory of your skills, resources, and interests. What are you good at? What do you enjoy doing? What resources do you have at your disposal, whether it's time, money, or expertise? This self-assessment will help you identify the most viable income streams for your current situation. For instance, if you have a knack for writing, you might start by creating a blog or writing e-books. If you're good with money, you might consider investing in dividend-paying stocks or real estate. 2. Start with one stream and build gradually. Start by focusing on one income stream at a time, and aim to build it up before moving on to the next. For instance, if you're starting with active income through a job or freelancing, focus on growing your skills and earning potential in that area first. Once you've stabilized that stream, you can start building a second stream, such as a side business or investment. For example, if you're a full-time employee, consider starting a side hustle, such as selling handmade goods online or offering consulting services. Once you've mastered that, you can use the income from your side hustle to invest in more passive streams, such as real estate or dividend-paying stocks. 3. Leverage technology and automation in today's digital age. Technology and automation make it easier than ever to create passive income streams. For example, if you're interested in creating an online business, you can use platforms like Shopify, Etsy, or Amazon to sell products without the need for a physical storefront. Tools like email marketing and automation software can help you maintain and grow these businesses with minimal time and effort. Similarly, investing in dividend stocks, mutual funds, or index funds can be done with just a few clicks on an investment platform, making it easier to build portfolio income over time. Automation tools also allow you to set up recurring investments or reinvest dividends, further compounding your wealth. 4. Scale your income streams over time. Once you've established one or two income streams, and they're running smoothly, focus on scaling them. Scaling means expanding your reach, increasing your output, or finding ways to generate more income from the same amount of effort. For example, if you're running an online store, you can scale by adding more products, increasing your marketing efforts, or expanding into new markets. If you're investing in real estate, you can scale by acquiring additional properties or by using the profits from one investment to fund others. 5. Protect and diversify your income streams. As you begin to build multiple income streams, it's important to protect and diversify them. For example, avoid putting all your investments in one type of asset. Diversify your portfolio across stocks, bonds, real estate, and other assets to reduce risk and ensure that your wealth is growing in multiple areas. Additionally, ensure that your passive income streams are legally protected by using the proper contracts, insurance, and business structures. Consult with professionals, lawyers, accountants, financial advisors, to make sure that you're taking the necessary steps to protect your wealth. Conclusion: creating multiple streams of income is one of the most powerful strategies for building wealth and achieving financial freedom. By diversifying your income, you can reduce financial risk, increase your earning potential, and create opportunities for passive growth. Whether you start with active income, passive income, or portfolio income, the key is to begin building today and gradually expand over time. Remember, wealth building is a marathon, not a sprint. The more you invest in yourself, learn about different income streams, and take action, the closer you'll be to achieving financial independence. Now is the time to start creating the multiple streams of income that will propel you toward the financial freedom you deserve. Chapter 4. Mastering budgeting and expense control. Mastering budgeting and expense control is one of the most critical steps on your journey to financial freedom. No matter how much money you earn, without a solid plan for how to manage and allocate your finances, wealth building can become a frustrating and elusive goal. Budgeting isn't just about tracking your spending. It's about taking full control over your financial situation, making intentional decisions about how to use your money, and ensuring that every dollar is working toward your long-term financial goals. In this chapter, we'll dive into the importance of budgeting, practical techniques for controlling expenses, and how to ensure that your money is being used efficiently to support your wealth building efforts. The importance of budgeting. A budget is essentially a financial blueprint that tells you where your money is going. When done properly, it ensures that you're not only covering your immediate expenses, but also saving and investing for the future. Without a budget, it's easy to fall into the trap of living paycheck to paycheck, overspending, or failing to build up savings. There are many reasons why budgeting is essential. Financial awareness. Budgeting gives you a clear picture of your income and expenses, making it easier to identify areas where you may be overspending or where you could save more. Achieving financial goals. A budget helps you allocate funds toward your financial goals, whether that's building an emergency fund, paying down debt, or investing in your future. Preventing debt. By controlling your expenses, you ensure that you're not living beyond your means, which helps you avoid accumulating unnecessary debt. Peace of mind. Knowing that you have a plan for your money reduces stress and helps you feel more in control of your financial situation. A well-crafted budget helps you make more informed financial decisions, prioritize your spending, and create a clear pathway to achieve your financial goals. Now that you understand why budgeting is important, let's look at how to create an effective budget. Creating a budget. The basics. Creating a budget may seem like a daunting task, but once you get started, it becomes much easier. The key to a successful budget is making sure it's realistic, flexible, and in line with your financial goals. Here's a step-by-step guide to creating your budget. 1. Track your income. The first step in creating a budget is understanding exactly how much money you're bringing in. This includes your salary, freelance earnings, business revenue, and any other sources of income you have. Be sure to account for all forms of income, including side hustles, investments, and any passive income streams you've created. Once you know your total monthly income, you'll have a solid foundation for creating your budget. 2. List your expenses. Next, you need to track your expenses. This includes both fixed expenses, so like rent or mortgage payments, utilities, and insurance, and variable expenses, such as groceries, entertainment, and transportation. Be honest about every expenditure, no matter how small. Take the time to go through your bank statements, credit card statements, and receipts to ensure you're not missing any regular expenses. You may be surprised at how many small, recurring payments, subscriptions, memberships, etc. add up over time. Categorize your expenses into two main groups: needs. These are essential expenses that you cannot live without, such as housing, utilities, food, and transportation. Wants. These are discretionary expenses, such as dining out, entertainment, and vacations. Tracking your expenses will give you a complete picture of where your money is going, helping you identify opportunities for savings. 3. Calculate the difference income vs. expenses. Once you know your income and expenses, subtract your total expenses from your total income. This will show you whether you're spending more than you're earning, or if you have extra income left over. If your expenses exceed your income, you'll need to adjust by cutting back on unnecessary spending, finding ways to increase your income, or both. If you have leftover income, that's great. You can allocate it towards savings, debt repayment, or investing to grow your wealth. 4. Set financial goals. Now that you have a clear picture of your income and expenses, set financial goals that align with your long-term vision. These goals will give you something to work toward and will guide how you allocate your money. Your goals might include building an emergency fund aimed to save 3-6 months worth of living expenses in case of unexpected events. Paying off debt. Set a target date to pay off high-interest credit cards or loans. Saving for a big purchase. Whether it's buying a home, a car, or going on vacation, plan for large expenses in advance. Investing for retirement. If you're not already investing, start contributing to retirement accounts, such as an IRA or 401k. Ensure your budget reflects your financial goals by allocating a portion of your income to each goal. Be realistic about how much you can save or invest each month, but stay committed to putting your money toward your long-term future. Techniques for expense control. Controlling your expenses is just as important as budgeting for savings. Even if you have a good income, it's easy to fall into the habit of overspending on wants instead of focusing on building wealth. The following techniques will help you control your expenses and ensure you're staying on track with your financial goals. 1. The 50-30-20 rule. One popular budgeting method is the 50-30-20 rule, which helps ensure you're balancing your needs, wants, and savings goals effectively. 50%. Allocate 50% of your income to essential needs, such as housing, utilities, and transportation. 30% spend 33% on discretionary wants, such as entertainment, dining out, and travel. This is where you can make adjustments to stay within your budget. 20% to put 20% of your income towards savings and debt repayment. This might include building your emergency fund, paying off debt, or investing in your future. By following this rule, you ensure that you're not overindulging in non-essential expenses while still making progress on your financial goals. 2. Automate savings and investments. One of the best ways to ensure that you stick to your savings and investment goals is to automate them. Set up automatic transfers from your checking account to your savings or investment accounts, so you're consistently building your wealth without having to think about it. This removes the temptation to spend the money on something else and helps you stay disciplined in your financial journey. 3. Cut back on unnecessary subscriptions. Many people have subscriptions or memberships that they rarely use, such as streaming services, magazines, or fitness clubs. Review your subscriptions regularly and eliminate any that no longer add value to your life. Even small savings from eliminating these expenses can add up over time. 4. Track your spending. Use budgeting apps or a spreadsheet to track your daily expenses. The more aware you are of your spending habits, the easier it will be to make adjustments. If you're constantly overspending in one category, such as dining out, make a plan to reduce those expenses in the coming months. 5. Embrace minimalism. Sometimes it's not just about cutting costs. It's about changing your lifestyle. Embrace a minimalist approach, by focusing on quality over quantity. Ask yourself if you really need that extra item or if it's something you can live without. The fewer things you accumulate, the more you'll save. Staying flexible and adjusting your budget. Your budget should be flexible and adaptable to changes in your financial situation. Life circumstances, such as job changes, a move, or unexpected expenses, may require you to adjust your budget. Make sure to revisit and update your budget regularly, especially if your income or expenses change. Be open to adjusting your financial goals as well. If you achieve a goal ahead of schedule, celebrate that success and set a new target. If you find that you're falling short of a goal, look at your budget and determine what adjustments need to be made. Conclusion: mastering budgeting and expense control is a foundational skill for achieving financial success. By creating a realistic budget, tracking your income and expenses, and controlling your spending, you set yourself up for long-term financial stability and wealth building. Budgeting isn't just about restriction. It's about taking charge of your finances, aligning your money with your goals, and setting yourself on the path to financial freedom. With the right tools and discipline, you'll be well on your way to mastering your money and achieving your financial aspirations. Chapter 5: Investing for long-term wealth. Building wealth isn't just about saving money. It's about putting your money to work for you. Investing is the key to unlocking long-term wealth, as it allows you to grow your assets over time by earning a return on the capital you put into different financial instruments. While saving provides a foundation, investing accelerates the process and offers the potential to build significant wealth that can last for generations. In this chapter, we will explore the fundamentals of investing, how to approach it with a long-term mindset, the different types of investment vehicles available, and how to make investing work for you. Why invest? Investing is essential for wealth building because it allows you to generate returns that outpace inflation, and it provides a way to grow your wealth beyond what you could achieve with savings alone. When you save money in a bank account, the interest rates are often low, and inflation can erode the value of your money over time. However, investing allows your money to compound and grow at a much higher rate, potentially achieving returns that significantly outpace inflation over the long run. By investing, you're essentially giving your money the opportunity to work for you, whether it's through the stock market, real estate, bonds, or other assets. Over time, the power of compound interest and consistent growth can turn a small initial investment into substantial wealth. The power of long-term investing. When it comes to investing, the key to success is patience. Building wealth through investing is not a get-rich-quick game. Rather, it's a slow and steady process that compounds over time. Long-term investing allows you to benefit from the power of compounding, where the returns on your investments generate additional returns, leading to exponential growth. The earlier you start investing, the more time your money has to grow. This is why it's crucial to begin investing as soon as possible, even if you can only start with a small amount. The goal is to build momentum so that your investments grow over time, generating wealth that you can use for future financial goals, whether that's retirement, purchasing property, or passing wealth down to future generations. Investment principles to live by. Before diving into specific investment options, it's important to understand some key principles that will guide your investment strategy. These principles will help you make informed decisions and stay the course as you invest for long-term wealth. 1. Start early and be consistent. The earlier you start investing, the more time your money has to grow. Even if you can only invest small amounts at first, the compounding effect will work in your favor. Additionally, consistency is key. Investing regularly, whether it's monthly, quarterly, or annually ensures that you continue to build wealth over time, regardless of market fluctuations. 2. Diversify your portfolio. Diversification means spreading your investments across different asset classes to reduce risk. A well-diversified portfolio contains a mix of stocks, bonds, real estate, and other investments. By doing so, you reduce the risk of losing all your money if one asset class underperforms. For example, if the stock market drops, your real estate investments might still be performing well, providing balance to your overall portfolio. 3. Focus on the long term. Long-term investing means you're less concerned with short-term fluctuations in the market and more focused on the long-term growth potential of your investments. Markets will go up and down, but history has shown that over time, they tend to trend upward. Patience and a long-term mindset allow you to avoid making emotional decisions during market downturns. 4. Understand risk and reward. Investing always involves some level of risk, but the level of risk varies depending on the type of investment. Generally, the higher the potential return, the higher the level of risk. It's important to understand your own risk tolerance and invest accordingly. A well-balanced portfolio will contain a mix of high-risk, high-reward assets, such as stocks, and lower-risk, lower-reward assets, such as bonds. 5. Reinvest your earnings. One of the most powerful tools in investing is the ability to reinvest your earnings, whether it's dividends, interest, or capital gains. Reinvesting your returns allows you to grow your portfolio exponentially, as you're using your earnings to generate even more earnings. This accelerates the compounding effect and significantly boosts your wealth-building efforts. Types of investments for long-term wealth. There are many different types of investments, each with its own risk profile and growth potential. In this section, we'll break down some of the most common investment options available to help you decide which ones are right for you. 1. Stocks. Stocks represent ownership in a company. When you buy a stock, you're essentially buying a small portion of that company. Stocks have the potential for high returns, but they also come with significant risk as their value can fluctuate based on company performance, economic conditions, and market sentiment. For long-term wealth building, investing in individual stocks or stock index funds can provide significant returns. Index funds, which track the performance of a broad market index like the S&P 500, offer diversification across many companies and tend to provide solid returns over time. 2. Bonds. Bonds are debt securities issued by companies or governments. When you invest in a bond, you're lending money to the issuer in exchange for periodic interest payments and the return of your principal when the bond matures. Bonds are typically considered lower risk than stocks, but they also tend to offer lower returns. For long-term investors, bonds can provide stability and steady income. A well-balanced portfolio should include both stocks and bonds to create a diversified mix of risk and reward. 3. Real estate. Real estate has long been considered one of the best ways to build long-term wealth. Property values tend to increase over time, and rental properties can provide a steady stream of passive income. In addition to appreciation and rental income, real estate investments offer several tax advantages, such as deductions for mortgage interest, property taxes, and maintenance costs. Real estate is also a relatively stable investment, as it's less subject to market volatility compared to stocks. However, real estate does require more capital upfront and may involve more hands-on management, especially if you're renting out property. 4. Mutual funds and exchange traded funds, ETFs. Mutual funds and ETFs are pools of money collected from many investors and used to invest in a diversified portfolio of stocks, bonds, or other assets. These funds allow you to gain exposure to a broad range of investments without having to pick individual stocks or bonds. Mutual funds are typically actively managed by fund managers, while ETFs are generally passively managed and track specific indexes. Both mutual funds and ETFs are excellent choices for long-term investors who want to diversify their portfolios with minimal effort. They offer easy access to a wide range of assets and are available for nearly every type of investor, from conservative to aggressive. 5. Real estate investment trusts, REITs. If you want to invest in real estate but don't have the capital or desire to own physical property, consider REITs. These are companies that own, operate, or finance real estate that generates income. By investing in REITs, you can gain exposure to the real estate market without the responsibilities of being a landlord. REITs offer the benefits of real estate investment, such as income generation and diversification, without the need to directly manage properties. They can be a valuable part of a long-term investment strategy. 6. Commodities. Commodities include natural resources such as gold, oil, agricultural products, and metals. Investing in commodities can be a good way to hedge against inflation, as their prices tend to rise during periods of economic instability. However, commodities can also be volatile and require a deep understanding of global markets. For long-term wealth building, commodities can play a role in your portfolio, especially if you're looking for diversification. Gold, for example, has historically served as a safe haven during economic downturns. Building your investment strategy. Once you've identified the types of investments that align with your financial goals and risk tolerance, it's time to build your investment strategy. A well-thought-out strategy includes setting specific financial goals, whether it's retirement, purchasing a home, or funding your children's education. Clearly define your goals so you can tailor your investments accordingly. Choosing the right asset allocation based on your risk tolerance and investment timeline. Determine the right balance of stocks, bonds, real estate, and other investments. Regularly reviewing and adjusting your portfolio as markets and life circumstances change. It's important to periodically review your investments and make adjustments to ensure they align with your goals. Staying disciplined. Investing for long-term wealth requires patience and discipline. Stick to your strategy. Avoid making emotional decisions based on short-term market fluctuations, and stay focused on your long-term goals. Conclusion: investing is one of the most powerful tools for building long-term wealth. By starting early, diversifying your portfolio, and staying disciplined, you can harness the power of compounding and create a wealth-building strategy that will serve you for years to come. Whether you're investing in stocks, bonds, real estate, or other assets, the key is to remain patient, consistent, and focused on the long-term horizon. The earlier you start and the more you invest wisely, the closer you'll be to achieving financial freedom. Chapter 6.3. The role of passive income in financial freedom. In the pursuit of financial freedom, one of the most powerful strategies is building passive income. Passive income refers to money earned with minimal active effort, allowing you to earn while you sleep, travel, or focus on other pursuits. Unlike traditional employment, where you trade time for money, passive income provides an opportunity to create wealth without constantly exchanging your time for dollars. In this chapter, we will explore the importance of passive income in achieving financial independence, how to create streams of passive income, and the mindset needed to build lasting wealth through this avenue. What is passive income? At its core, passive income is money that flows in regularly, without requiring the active, day-to-day effort that traditional jobs demand. There are two main types of passive income. Earned passive income. This is income that requires initial effort to set up, but becomes relatively hands-off once established. Examples include income from investments, rental properties, royalties, or digital products. Unearned passive income This income often requires more long-term capital investment, such as income from dividends, interest on savings, or annuities. It doesn't require ongoing work once set up. There's typically a need for an initial monetary investment. The beauty of passive income is that it allows you to leverage your time, money, and resources in a way that enables your wealth to grow continuously, with little direct involvement. The goal is to create multiple passive income streams that work for you and grow without your constant attention. Why passive income is key to financial freedom. Financial freedom is the ability to live life on your terms, without being tied to a 9-to-5 job or constantly worrying about money. Passive income is a fundamental part of this equation because it allows you to earn without having to be physically present or working actively. Here are some reasons why passive income is critical for financial freedom. Time freedom. Passive income allows you to free up your time. Once you have established your passive income streams, you can use your time for personal pursuits, travel, or new ventures without worrying about losing money. You can choose how to spend your days, whether it's pursuing hobbies, spending time with family, or working on passion projects. Financial security. Relying solely on earned income from a job can create financial vulnerability, especially if your income is unstable or if you're unable to work due to unforeseen circumstances. Passive income creates a safety net, ensuring that you have a consistent revenue stream, even if your primary income source is disrupted. Wealth creation. Passive income gives you the ability to compound your wealth over time. Rather than trading hours for dollars, passive income allows you to accumulate wealth that works for you. For instance, income from investments or rental properties can be reinvested, creating even more wealth. The power of compounding is a game changer for building long-term wealth. Scalability. Unlike active income, which has limitations based on how much time you can work, passive income can scale. With the right strategy, you can create multiple income streams, each contributing to your overall wealth. The more income streams you build, the more leverage you have to accelerate your journey toward financial freedom. Types of passive income streams. Building passive income takes time and effort up front, but once you've set up systems, it becomes much easier to maintain. Here are some of the most common and accessible ways to generate passive income. 1. Real estate investments. Real estate is one of the most reliable and effective ways to generate passive income. Whether through buying rental properties, investing in commercial real estate, or joining a real estate investment group, owning property can provide a consistent stream of rental income. Additionally, real estate tends to appreciate over time, increasing your wealth as property values rise. Rental properties, one of the most traditional and successful forms of passive income. Rental properties generate regular cash flow through monthly rent payments, while managing tenants and property maintenance requires effort initially. You can eventually hire property managers to handle the day-to-day operations. Real estate investment trusts, REITs. If direct property ownership isn't for you, REITs are a great option. These are companies that own and operate income-producing real estate, and they allow investors to purchase shares and earn passive income from rents and sales. REITs are publicly traded, providing liquidity and ease of access for investors. 2. Dividend stocks. Investing in dividend-paying stocks is a popular strategy for earning passive income. Many established companies pay out a portion of their profits to shareholders in the form of dividends. By building a portfolio of dividend-paying stocks, you can create a steady stream of income that requires minimal effort to maintain. The key to success with dividend stocks is to focus on companies with a strong history of paying consistent dividends, as well as those with a stable financial track record. Reinvesting dividends can help grow your portfolio creating a compounding effect over time. 3. Peer-to-peer lending. Peer-to-peer 2P lending platforms allow you to lend money to individuals or businesses in exchange for interest payments. P2P lending offers attractive returns, especially when compared to traditional savings accounts or bonds. The risk, however, is higher, as there is a possibility of borrower default. When using P2P lending as a source of passive income, it's important to diversify your loans to mitigate risk and ensure a steady flow of interest income. 4. Creating and selling digital products. The rise of the digital economy has opened up countless opportunities for passive income. One of the most powerful ways to generate passive income is by creating and selling digital products. These can include e-books. Writing and publishing an e-book can provide a source of income for years to come. Once written and published, the e-book can sell on platforms like Amazon, with little effort required after the initial launch. Online courses. If you have expertise in a particular area, creating an online course can be a lucrative way to share your knowledge and generate passive income. Once the course is created and launched, it can be sold to new students without ongoing effort. Stock photography or art. If you're a photographer or artist, you can sell your work on platforms like Shutterstock or Etsy. Once your work is uploaded, you can earn passive income each time someone purchases your images or artwork. 5. Affiliate marketing. Affiliate marketing involves promoting products or services and earning a commission for each sale made through your referral. This is an ideal way to earn passive income if you have a blog, website, or large social media following. The more content you create and share, the more opportunities you have to generate affiliate income. Successful affiliate marketers often focus on niche markets, providing value through product reviews, recommendations, and content that helps users make informed purchasing decisions. Over time, these efforts can generate a steady stream of income as visitors make purchases through your affiliate links. 6. Creating a YouTube channel or podcast. If you enjoy creating content, YouTube and podcasting are excellent avenues for passive income. While it takes time to build an audience, once you have a substantial following, you can monetize your content through ads, sponsorships, and merchandise sales. Both platforms offer long-term income potential through revenue, with your videos or podcasts continuing to earn money even after they've been published. 7. Licensing intellectual property. If you have a unique invention, creative work, or intellectual property, licensing it to companies or individuals can generate passive income. This is especially relevant for those with patents, trademarks, or copyrighted material. By licensing your intellectual property, you can receive royalty payments each time your work is used. Building a strategy for passive income. To successfully create passive income, you need a clear strategy. Here are some key steps to help you get started. Assess your financial situation. Understand how much capital you can allocate to passive income ventures and how much time you're willing to invest upfront to set them up. Choose the right passive income streams. Based on your skills, resources, and risk tolerance, choose a mix of passive income streams that align with your financial goals. It's best to diversify to mitigate risk and ensure consistent returns. Automate and outsource it. As you begin to establish passive income streams, find ways to automate and outsource processes. For example, use property management services for rental properties or hire virtual assistants for online businesses. Reinvest your earnings. To build long-term wealth, reinvest your passive income into new income-generating assets. This strategy accelerates growth and helps you achieve financial freedom faster. Be patient. Building passive income takes time. The key is to stay committed, make informed decisions, and consistently work on expanding your income streams. Conclusion: passive income is a powerful tool in the pursuit of financial freedom. By creating streams of income that generate money with minimal ongoing effort, you can achieve wealth and security while freeing up your time to pursue other passions. The journey to financial freedom involves building multiple passive income sources, diversifying your portfolio, and leveraging your resources effectively. With patience, persistence, and the right strategy, passive income can be the cornerstone of your financial success. Chapter 700: Entrepreneurship and Wealth Creation. Entrepreneurship is one of the most powerful vehicles for wealth creation. It allows individuals to not only take control of their financial destiny, but also create opportunities for others, drive innovation, and build long-lasting legacies. In this chapter, we will explore how entrepreneurship plays a pivotal role in building wealth, the mindset of successful entrepreneurs, and how to navigate the entrepreneurial journey to achieve financial freedom. What is entrepreneurship? At its core, entrepreneurship is the process of identifying opportunities, taking calculated risks, and creating value through the development of products, services, or solutions. Entrepreneurs are innovators, problem solvers, and risk takers who leverage their creativity and skills to start businesses that provide value to society. Introduction. Entrepreneurship is different from traditional employment because it involves more risk, but it also provides more freedom and the potential for greater financial rewards. Successful entrepreneurs are able to build scalable businesses that can generate consistent income, grow wealth, and provide financial freedom for themselves and their families. The role of entrepreneurship in wealth creation. Entrepreneurship plays a crucial role in wealth creation because it provides a pathway to financial independence. Unlike a salaried job, where income is often limited by time and effort, an entrepreneurial venture can grow exponentially and generate wealth that isn't tied to personal labor. Here's how entrepreneurship creates wealth. Scalability. One of the key advantages of entrepreneurship is scalability. A business, once established, can grow beyond the limits of your time and energy. With the right systems, processes, and people in place, your business can expand, generate larger profits, and eventually allow you to step back from day-to-day operations while continuing to earn passive income. Equity and ownership. As an entrepreneur, you own your business. This ownership means that you have control over how it operates, and, more importantly, you reap the rewards of its success. As your business grows, so does its value. By building a successful company, you accumulate equity, which can be sold or passed on, creating wealth that can outlast your lifetime. Job creation. Entrepreneurs don't just create wealth for themselves. They also create wealth for others. By hiring employees, partnering with suppliers, and providing services to customers, entrepreneurs have a ripple effect that generates economic activity. As your business grows, so does its ability to support jobs and stimulate economic growth. Financial independence. Entrepreneurship provides a direct route to financial freedom. While starting a business requires time, effort, and initial investment, it ultimately offers the potential to generate substantial income that can lead to financial independence. Entrepreneurs have the ability to earn money on their own terms, making entrepreneurship one of the most viable paths to wealth creation. Innovation and competitive advantage. Entrepreneurs drive innovation by creating products or services that solve problems or improve upon existing solutions. Innovation can give you a competitive edge in the market, allowing you to capture a larger share of the market, increase revenues, and grow your wealth. The entrepreneurial mindset. The entrepreneurial mindset is essential to wealth creation. It's about adopting a set of attitudes, beliefs, and behaviors that help you succeed in business. Here are some key elements of the entrepreneurial mindset. Risk taking. Entrepreneurship inherently involves risk. However, successful entrepreneurs view risk not as something to avoid, but as something to manage. They take calculated risks based on data, experience, and careful analysis. They understand that failure is part of the process and that setbacks are learning opportunities. Resilience building a business is rarely a smooth journey. There will be challenges, obstacles, and setbacks along the way. The key to overcoming these difficulties is resilience. Entrepreneurs must have the ability to stay focused on their long-term goals and bounce back from failures. Resilience enables them to persevere and adapt to changing circumstances, ensuring their success in the face of adversity. Vision entrepreneurs are visionary. They have a clear picture of what they want to create and the impact they want to make. This vision keeps them motivated, helps them set goals, and guides them when tough decisions need to be made. Compelling vision serves as the North Star for an entrepreneur, helping them stay on track and inspiring others to join them in their mission. Problem-solving entrepreneurs are natural problem solvers. They see challenges as opportunities to innovate and improve. Whether it's finding new ways to serve customers or streamlining business operations, entrepreneurs constantly seek solutions to problems. Their ability to solve problems not only leads to business growth, but also creates value for others, which is key to long-term wealth creation. Self-belief. Self-belief is one of the most important qualities of a successful entrepreneur. You must believe in your ability to succeed, even when faced with uncertainty. This self-confidence enables you to take bold actions, make tough decisions, and push forward when others may give up. Continuous learning. Successful entrepreneurs understand that learning doesn't stop once they start their business. In fact, continuous learning is a key factor in their success. They are always seeking new knowledge, whether through formal education, reading, networking, or learning from mentors. Entrepreneurship requires adaptability and staying informed about market trends, new technologies, and changes in the industry. How to get started with entrepreneurship. Starting a business can seem like a daunting task, but with the right strategy and mindset, anyone can embark on the entrepreneurial journey. Here are the steps to get started. Identify a market need. Every successful business starts with solving a problem. Look for gaps in the market, unmet needs, or areas where current solutions are inadequate. Conduct market research to validate your ideas and ensure that there is a demand for your product or service. Create a business plan. A solid business plan is essential for outlining your business goals, strategies, target audience, and financial projections. It helps you clarify your vision and gives you a roadmap for success. A business plan also helps you secure funding if needed and serves as a guide for decision-making. Secure funding. Many entrepreneurs start with personal savings or small loans to fund their businesses. However, as your business grows, you may need external funding from investors, banks, or venture capitalists. Be prepared to pitch your business and demonstrate how it will generate revenue and achieve profitability. Build your brand. Establish a strong brand identity that resonates with your target market. Your brand should communicate your business's values, mission, and unique selling proposition. A powerful brand helps you stand out in the marketplace and attract customers. Create systems and processes. As your business grows, it's important to have systems and processes in place to ensure efficiency and scalability. This includes creating standard operating procedures, SOP, investing in software tools for automation, and delegating tasks to employees or contractors. Take action and start small. While planning is essential, action is where the magic happens. Start small, test your ideas, and iterate as you go. The most successful entrepreneurs take consistent, purposeful action, learning and refining their approach along the way. Don't wait for the perfect moment. Just begin. Focus on customer value. Successful businesses thrive by providing value to customers. Focus on building relationships, delivering exceptional products or services, and exceeding customer expectations. Satisfied customers are more likely to return, recommend your business, and provide positive reviews. Driving growth and wealth creation. Wealth creation strategies for entrepreneurs. Entrepreneurs can build wealth by applying a few key strategies. Leverage the power of compounding. Much like investing, entrepreneurship benefits from the compounding effect. Reinvesting profits back into the business, expanding operations, or launching new products helps your business grow exponentially over time. Diversify your income sources. Successful entrepreneurs often diversify their income streams by launching multiple products, expanding into new markets, or creating complementary businesses. This diversification helps protect against risks and increases overall wealth generation. Build systems for passive income. Entrepreneurs can create passive income streams within their businesses. For example, creating online courses, selling digital products, or establishing subscription models can generate ongoing revenue without requiring constant effort. Scale your business. Scaling is one of the most effective ways to create wealth as an entrepreneur. As your business grows, your potential to generate income multiplies. Focus on systems, automation, and delegation to scale your business efficiently. Exit strategy and asset building. Many entrepreneurs eventually sell their businesses or take them public through an IPO initial public offering. By building valuable assets and creating a plan for an exit strategy, entrepreneurs can monetize their businesses for significant wealth. Conclusion: entrepreneurship is one of the most powerful paths to wealth creation. By leveraging your skills, creativity, and the entrepreneurial mindset, you can build a business that generates financial freedom for you and creates opportunities for others. Entrepreneurship isn't without its risks, but it offers unparalleled rewards for those who are willing to invest in themselves, take calculated risks, and continuously innovate. Whether you're starting small or building a global empire, the principles of entrepreneurship can lead to lasting wealth and financial independence. Chapter 8: Managing debt wisely. Debt is often viewed as a burden, something to be avoided or feared. However, when managed correctly, debt can be a tool that helps you build wealth and achieve financial goals. In this chapter, we will explore the strategies for managing debt wisely, understanding when it is appropriate to take on debt, and how to use debt to propel your wealth building journey rather than hold you back. Understanding debt. The good and the bad debt is essentially money that you owe to others, and it can take many forms: credit cards, student loans, mortgages, business loans, and more. Not all debt is created equal, and it's important to differentiate between good debt and bad debt. Good debt. Good debt is debt that helps you generate wealth, increase your earning potential, or improve your financial position in the long run. Examples of good debt include mortgages. A home loan can be considered good debt because it enables you to purchase property that can appreciate in value over time. Student loans. When used wisely to finance education, student loans can increase your earning potential by providing the skills and qualifications needed for a higher-paying job. Business loans. Debt used to invest in a business venture with high growth potential can be considered good debt because it may lead to increased profits and long-term wealth. Bad debt. Bad debt is debt that does not create long-term value and only serves to drain your resources. This type of debt is typically high-interest debt and is used to purchase things that don't increase in value. Examples of bad debt include credit card debt. Using credit cards to finance everyday purchases, especially when you carry a balance month to month, often leads to high interest payments that don't contribute to wealth creation. Consumer loans. Taking out loans to finance non-essential items like luxury goods or vacations is generally considered bad debt, as these items lose value over time. High-interest payday loans. These types of loans come with exorbitant interest rates and can quickly spiral out of control if not managed properly. The dangers of uncontrolled debt. When debt becomes unmanageable, it can quickly spiral out of control and become a major obstacle to achieving financial freedom. The most significant dangers of uncontrolled debt include high interest payments. Credit cards and payday loans often come with high interest rates, making it difficult to pay off the principal balance. The longer you carry a balance, the more you pay in interest, which only makes it harder to reduce your debt over time. Financial stress. Debt can cause significant emotional and psychological stress. The fear of not being able to make payments, the constant worry about creditors, and the sense of financial insecurity can all take a toll on your mental health and well-being. Credit damage. Failing to manage debt properly can negatively impact your credit score, making it more difficult to obtain favorable interest rates or access credit in the future. A damaged credit score can increase the cost of borrowing and limit opportunities for financial growth. Opportunity cost. The money spent on interest payments could be better used for wealth-building activities, such as investing or saving for the future. Uncontrolled debt limits your ability to take advantage of these opportunities. The importance of managing debt wisely. Managing debt wisely is essential for achieving financial freedom. When handled properly, debt can be an effective tool for leveraging your resources to build wealth, whether through homeownership, business expansion, or education. However, it's crucial to maintain a balance and ensure that your debt doesn't become a financial burden that holds you back from your goals. Here are some practical steps to manage debt wisely. 1. Assess your current debt situation. Before you can begin managing your debt, you need to understand your current debt situation. Take a detailed inventory of all your debts, including credit cards, student loans, mortgages, personal loans, and any other liabilities. For each debt, note the interest rate, minimum monthly payment, and outstanding balance. This will help you prioritize which debts to focus on first, as you'll want to pay down high-interest debts quickly to minimize the cost of interest. 2. Create a debt repayment strategy. Once you have a clear picture of your debt, it's time to create a strategy for paying it off. There are several debt repayment strategies that can help you get out of debt faster and with less interest. Debt snowball method. This method involves paying off the smallest debt first while making minimum payments on all other debts. Once the smallest debt is paid off, you move on to the next smallest debt, and so on. The momentum you gain from paying off smaller debts can motivate you to continue tackling larger debts. Debt avalanche method. The debt avalanche method focuses on paying off the debt with the highest interest rate first. Once that debt is paid off, you move on to the next highest interest rate, and so on. This method is the most cost-effective because it reduces the amount of interest paid over time. Consolidation or refinancing. If you have multiple high-interest debts, you may want to consider consolidating them into one loan with a lower interest rate. Debt consolidation or refinancing can simplify your payments and save you money on interest. 3. Control spending and avoid new debt. In order to pay down existing debt, it's crucial to stop accumulating more. Control your spending by tracking your expenses and creating a budget that allows you to allocate more funds to debt repayment. Avoid using credit cards for non-essential purchases and refrain from taking on new loans unless absolutely necessary. Set clear financial goals for yourself and remind yourself that each dollar spent on new debt is a dollar taken away from your debt repayment or wealth building goals. 4. Build an emergency fund. One of the best ways to avoid taking on more debt in the future is to build an emergency fund. An emergency fund acts as a financial safety net, preventing you from relying on credit cards or loans when unexpected expenses arise. Aim to save at least 3 to 6 months' worth of living expenses in a liquid savings account that is easily accessible. By having an emergency fund, you can avoid going into debt for situations like medical bills, car repairs, or job loss. Having financial peace of mind allows you to focus on paying off your existing debt and continuing your journey toward financial freedom. 5. Refinance and negotiate interest rates. If you have high interest debt, it's worth exploring options to refinance or negotiate for better interest rates. For example, you may be able to refinance a mortgage or car loan to secure a lower interest rate, which will reduce your monthly payments and the total interest you pay over the life of the loan. You can also reach out to credit card companies to negotiate a lower interest rate, especially if you have a good payment history with them. Many creditors are willing to work with customers to avoid default, so don't hesitate to ask. 6. Use debt to build wealth. Once you've gotten a handle on managing your debt, you can consider using debt strategically to build wealth. As mentioned earlier, certain types of debt, such as mortgages, student loans, and business loans, can be considered good debt if they are used to increase your financial standing. For instance, using a business loan to expand a profitable venture can lead to increased revenue and long-term wealth. Similarly, using debt to finance a home purchase allows you to build equity over time. However, it's essential to be cautious and make sure that any debt you take on is aligned with your long-term wealth building goals. 7. Focus on improving your credit score. Managing debt wisely also means focusing on maintaining a healthy credit score. Your credit score plays a critical role in your financial health, affecting your ability to secure loans, access favorable interest rates, and even get hired in certain industries. To improve your credit score, make sure to pay all of your bills on time. Pay down high interest debts to lower your credit utilization ratio. Avoid opening unnecessary credit accounts. Regularly check your credit report for any errors or inaccuracies. A good credit score can open doors to better financial opportunities, such as lower interest loans or credit cards with rewards. Conclusion: debt doesn't have to be a roadblock to financial freedom. By understanding the different types of debt and managing it wisely, you can use it as a tool to build wealth and achieve your financial goals. The key is to stay disciplined, create a plan, and focus on reducing high interest debt first while building a solid foundation for long-term financial success. With the right strategies, you can navigate debt with confidence and move closer to achieving financial independence. Chapter 9: Building and protecting your credit score. Your credit score is one of the most powerful tools in your financial arsenal. It affects nearly every aspect of your financial life, from your ability to borrow money and qualify for loans to the interest rates you'll pay, and even your job prospects. In this chapter, we'll explore why your credit score is so important, how to build it from the ground up, and strategies to protect it as you work toward financial freedom. What is a credit score? A credit score is a numerical representation of your creditworthiness. It's calculated based on several factors in your credit history, including your borrowing habits, how much debt you owe, your payment history, and the types of credit accounts you have. Lenders, landlords, and even employers use your credit score to assess how risky you are as a borrower or tenant, and it helps them decide whether or not to offer you credit, rent, or employment. Credit scores typically range from 300 to 850, with higher scores indicating better creditworthiness. The major credit reporting agencies: Equifax, Experian, in TransUnion. Use various models to calculate your score, but the most widely used is the FIFO score. Why your credit score matters. A good credit score is essential for achieving financial freedom. Here's why. Lower interest rates. The higher your credit score, the lower the interest rate you'll be offered on loans and credit cards. A good score can save you thousands of dollars in interest over the life of a loan. Better loan terms. A strong credit score can help you secure loans with more favorable terms, such as higher loan amounts, longer repayment periods, and flexible conditions. Access to credit. A poor credit score may result in loan denials or higher interest rates, making it difficult to access credit for essential purchases like a home, car, or business. Insurance premiums. Many insurance companies use your credit score to determine your premiums. A low score may result in higher premiums for car or homeowners insurance. Employment opportunities. Certain employers, particularly in the financial sector, check credit scores as part of the hiring process. A poor score may limit your career opportunities. How to build your credit score. Building a solid credit score requires a strategy and some patience. The good news is that anyone, regardless of where they start, can improve their credit score over time by following the right steps. 1. Check your credit report regularly. The first step in building and protecting your credit score. To understand where you currently stand, request your free credit reports annually from each of the 3 major credit reporting agencies, Equifax, Experian, and TransUnion, through Annual Credit Report. Reviewing your credit reports allows you to check for errors and discrepancies that may be affecting your score. If you notice any mistakes, such as incorrect accounts or late payments, dispute them with the credit bureau. Incorrect information can negatively impact your credit score, so it's essential to address these issues promptly. 2. Pay your bills on time. One of the most important factors affecting your credit score is your payment history. Late or missed payments can have a significant negative impact on your credit score, so it's crucial to make your payments on time. Every time, set up reminders or automatic payments to ensure you never miss a due date. Even a single missed payment can stay on your credit report for up to 7 years. So consistency is key to building a strong credit history. 3. Keep your credit utilization low. Credit utilization is the ratio of your credit card balances to your credit limits. It accounts for about 30% of your credit score, making it one of the most important factors to manage. As a rule of thumb, you should aim to keep your credit utilization below 30%. For example, if your credit card has a limit of $10,000, try to keep your balance under $3,000. If you're consistently carrying high balances, it could signal to lenders that you're overly reliant on credit, which can lower your score. 4. Open new credit accounts only when necessary, while having a variety of credit accounts, credit cards, installment loans, mortgages, etc. can improve your credit score. Opening too many new accounts in a short period of time can hurt your score. Each time you apply for credit, a hard inquiry is made on your credit report, which can temporarily lower your score. Only open new credit accounts when necessary and avoid applying for too many credit cards or loans at once. Over time, having a diverse range of credit accounts in good standing will help boost your credit score. 5. Keep old accounts open. The length of your credit history accounts for about 15% of your credit score. Having a long, positive credit history can help improve your score. If you have old credit cards or accounts with no balances, it's a good idea to keep them open, even if you're not using them. Closing old accounts can shorten your credit history and negatively impact your score. If you're concerned about the potential for fraud, consider periodically checking in on your old accounts without actually closing them. 6. Diversify your credit types. Credit scoring models also consider the types of credit accounts you have. a mix of credit types, such as credit cards, retail accounts, and installment loans as car loans, mortgages, etc., can help improve your score. However, don't open new credit accounts just to diversify your credit mix. It's better to focus on responsible management of your existing accounts rather than opening new ones unnecessarily. 7. Deal with delinquencies and collections. If you have past due accounts or debts in collections, it's crucial to address them as quickly as possible. Delinquencies and collections can have a significant negative impact on your credit score. If a debt is in collections, try to negotiate with the collection agency for a settlement or payment plan. Once the debt is paid off or settled, request that the collection agency remove the record from your credit report, or at least mark it as paid or settled. If you're dealing with multiple delinquencies, consider working with a credit counselor to help negotiate your debts and get back on track. 8. Become an authorized user. If you're just starting to build your credit or you have a low credit score, consider becoming an authorized user on someone else's credit card account. This allows you to benefit from their positive payment history without being responsible for the payments. Be sure that the primary account holder has a solid payment history, as their actions will impact your score. Being an authorized user can be a great way to build your credit score quickly, especially if you're unable to get approved for credit on your own. How to protect your credit score. Once you've built a strong credit score, it's important to protect it. Here are some strategies to ensure your credit remains in good standing. 1. Monitor your credit regularly. Stay on top of your credit by regularly monitoring your credit score and credit report. Many services offer free or low-cost credit score tracking, so you can spot any changes and address potential issues before they affect your score. 2. Avoid identity theft. Protecting your credit score also means protecting your personal information from fraud and identity theft. Be cautious about sharing your personal details online, and regularly check your bank and credit card statements for any unauthorized transactions. You can also freeze your credit to prevent anyone from opening new accounts in your name without your permission. 3. Stay vigilant about late payments. Late payments can harm your credit score, so it's crucial to stay on top of your bill payments. Set up reminders, automate your payments, or use budgeting apps to help you avoid missing due dates. 4. Keep debt under control. Avoid accumulating too much debt, as high balances can negatively impact your credit score. Use your credit responsibly, and always aim to pay off your balances in full each month. Conclusion: building and protecting your credit score is essential for long-term financial success. A strong credit score opens doors to better loan terms, lower interest rates, and greater financial opportunities. By paying your bills on time, managing your credit responsibly, and monitoring your credit regularly, you can ensure that your credit score remains in good standing, helping you achieve financial freedom and build the life you desire. Chapter 10. The Psychology of Money. Overcoming financial fears. Money is more than just numbers in a bank account or bills that need to be paid. It's tied deeply to our emotions, our upbringing, and our sense of security. Often, how we think about money influences our financial behaviors more than any objective financial advice ever could. Our beliefs, fears, and attitudes toward money play a major role in determining whether we thrive or struggle financially. In this chapter, we will explore the psychology of money, how our mental and emotional relationship with money affects our financial decisions, and how we can overcome the financial fears that hold us back from achieving financial freedom. Understanding the psychology of money. The psychology of money refers to how we think about, feel about, and behave with respect to money. It's shaped by our childhood experiences, social environment, culture, and personal beliefs. Our thoughts and feelings about money can either empower us to make smart, strategic financial decisions or cause us to make poor choices that hinder our progress. Money is often seen as a symbol of status, security, or freedom. How we view money is shaped by many factors, including childhood experiences, the financial habits and beliefs we learn from our parents or caregivers influence how we approach money as adults. If you grew up in a household where money was scarce, you might associate financial security with safety and stability. On the other hand, if you saw your parents overspending or mismanaging money, you may develop fears or negative feelings about money. Cultural influences. Our society often sends mixed messages about money. On one hand, we're encouraged to strive for financial success. On the other hand, there's a stigma around discussing money openly. These conflicting messages can make it difficult to develop a healthy relationship with money. Personal beliefs. Your personal money beliefs, whether conscious or unconscious, can dictate your financial habits. If you believe that money doesn't grow on trees, or that rich people are greedy, you may subconsciously sabotage your financial progress, either by limiting yourself or by feeling undeserving of wealth. The key to unlocking financial freedom lies in understanding and reshaping these deep-rooted psychological influences on money. When you change your mindset, you can change your financial reality. Common financial fears and how to overcome them. Fear is a powerful emotion that often drives our financial behavior. It can cause us to make poor financial decisions, such as avoiding investing or hoarding money in low-interest accounts, out of a desire to avoid risk or loss. Below are some of the most common financial fears people face, along with strategies to overcome them. 1. Fear of losing money, so loss aversion. One of the most common financial fears is the fear of losing money. This is rooted in loss aversion, a psychological phenomenon where losses are perceived as more painful than gains are pleasurable. This fear often leads people to avoid taking risks or making investments altogether, resulting in missed opportunities for growth. How to overcome it? Shift your perspective on risk. Understand that all financial ventures involve some degree of risk, but the greater risk is doing nothing. Start by taking small, calculated risks that align with your financial goals. Learn to view investment as an opportunity for growth, not something to fear. Educate yourself. The more you understand how investments work, the less intimidating they become. Knowledge is the antidote to fear. Take time to educate yourself about investing, financial planning, and the potential rewards of taking calculated risks. Diversify your investments. Diversification helps spread risk across different asset classes, which can minimize the impact of any one investment performing poorly. A well-diversified portfolio will help you feel more secure in the face of potential losses. 2. Fear of not having enough, a scarcity mindset. A scarcity mindset is the belief that there is never enough money to go around. People with a scarcity mindset often feel like they have to cling to every dollar because they fear running out of money. This fear can lead to hoarding, oversaving, or even making poor financial decisions driven by the belief that wealth is limited and hard to come by. How to overcome it? Adopt an abundance mindset. Shift your thinking from "there is never enough" to "there is more than enough." The belief that opportunities for growth and wealth are abundant will open you up to new possibilities and help you take proactive steps toward creating wealth. Focus on earning, not just saving. While saving money is important, don't make the mistake of focusing solely on cutting expenses. Focus on increasing your income by exploring new opportunities, whether through career advancement, side hustles, or investments. Practice gratitude. Practicing gratitude for what you have helps break the cycle of fear and scarcity. When you focus on what's working in your financial life, rather than what's lacking, you attract more abundance. 3. Fear of failure. If fear of not being good enough. Many people avoid pursuing their financial goals because they're afraid of failure. This fear can paralyze them from taking the necessary steps to achieve financial freedom. Fear of failure often stems from self-doubt or the belief that you're not capable of succeeding financially. How to overcome it? Embrace failure as a learning opportunity. Introduction. Understand that failure is not the end of the road. It's part of the process. Every financial mistake you make offers valuable lessons that can help you make better decisions in the future. Rather than fearing failure, embrace it as a natural part of growth. Set small, achievable goals. Breaking down large financial goals into smaller, manageable steps can reduce the fear of failure. Achieving small wins along the way will build your confidence and motivate you to continue working toward larger goals. Practice self-compassion. Be kind to yourself when things don't go as planned. Treat yourself with the same understanding and encouragement you would offer a friend in the same situation. 4. Fear of not being able to retire. Retirement anxiety. As we get older, many people begin to feel anxious about their ability to retire comfortably. The fear of not having enough saved for retirement can be overwhelming, especially with rising living costs and the uncertainty of future Social Security benefits. How to overcome it? Start saving early. The earlier you start saving for retirement, the better. Even small contributions can grow significantly over time, thanks to the power of compound interest. If you haven't started saving for retirement yet, don't panic. Start today, even if it's just a small amount. Plan and automate it. Create a retirement savings plan and automate your contributions. Setting up automatic transfers into a retirement account ensures that you're consistently saving without having to think about it. Consult a financial advisor. A financial advisor can help you design a retirement strategy that aligns with your financial goals. They can help alleviate the anxiety around retirement by providing clarity and guidance on how much you need to save and where to invest. 5. Fear of missing out, FOMO. The fear of missing out, or FOMO, can drive irrational financial decisions, especially in the age of social media. People may feel pressured to keep up with others' financial successes or trends, such as the latest investment craze or luxury purchase. How to overcome it? Define your own financial goals. Focus on your own financial journey and set clear, personal financial goals. Recognize that everyone's path to financial freedom is unique, and comparing yourself to others can be counterproductive. Practice mindful spending. Before making any purchase, ask yourself if it aligns with your values and long-term goals. Avoid impulse spending driven by social pressures or the need to keep up with the Joneses. Developing a healthy money mindset. Overcoming financial fears begins with developing a healthy relationship with money. This means understanding that money is a tool, one that can be used to create opportunities, improve your life, and achieve your goals. To develop a healthier mindset around money, practice mindfulness. Be mindful of your thoughts and emotions when it comes to money. Recognize when fear or negative beliefs arise and challenge them with positive, empowering thoughts. Reframe your beliefs. If you catch yourself thinking negatively about money, try to reframe those beliefs. For example, instead of thinking, "I'll never be able to afford this," reframe it to, "How can I afford this in a way that aligns with my goals?" Take action. Fear often stems from inaction or the unknown. The best way to overcome financial fears is to take small, confident steps toward your financial goals. Whether it's starting a budget, investing for the future, or negotiating a raise, action is the antidote to fear. Conclusion: money is as much a psychological and emotional challenge as it is a financial one. By understanding the underlying fears that drive your financial behaviors, you can begin to reframe your mindset and take control of your financial future. Overcoming these fears requires patience, self-awareness, and consistent action. As you work to develop a healthy, empowered relationship with money, you'll find that financial freedom becomes not only possible, but inevitable. Chapter 11. Smart Saving Strategies for Wealth Accumulation. Saving money is one of the most essential aspects of achieving financial freedom. While investing and creating income streams are vital, saving serves as the foundation on which wealth is built. Smart saving strategies allow you to preserve your income, make it work for you, and accumulate wealth over time. This chapter will explore how to save effectively, the best strategies for long-term wealth accumulation, and how to avoid common mistakes that can hinder your progress. The importance of saving for wealth accumulation. Saving money is not just about setting aside a portion of your income each month. It's about creating a financial buffer that allows you to invest, manage emergencies, and build a solid foundation for your financial future. The act of saving is not just for short-term goals like vacations or new purchases, but should be part of a long-term plan for wealth accumulation. The power of saving lies in its ability to create opportunities. Whether you're looking to invest in the stock market, start a business, or buy real estate, having savings gives you the flexibility to take advantage of opportunities as they arise. In addition, saving regularly helps cultivate discipline, patience, and financial awareness, all critical habits for long-term wealth creation. The 50-30-20 rule. A simple framework for smart saving. One of the easiest and most popular saving strategies is the 50-30-20 rule. This simple framework divides your income into 3 categories. 50% needs. This includes essential expenses like rent or mortgage, utilities, groceries, transportation, and insurance. These are non-negotiable expenses that you must pay each month to maintain a basic standard of living. 30% wants. This category includes discretionary spending, such as dining out, entertainment, subscriptions, and other non-essential purchases. While these expenses are important for your quality of life, they should be kept in check to allow for more savings and investing. 20% savings. This is the critical portion of your income that should be dedicated to saving and investing. Ideally, this percentage should be increased as your income grows or if you want to accelerate your wealth accumulation. This rule helps you balance the need for a comfortable lifestyle with the importance of saving and investing. By following this framework, you ensure that you live within your means while making progress toward your long-term financial goals. Automating your savings. One of the most effective ways to save consistently is by automating your savings. Automation takes the guesswork and temptation out of the equation, ensuring that you're putting money aside each month without having to think about it. Here's how to set up automated savings. Direct deposit. Many employers offer direct deposit of your paycheck, and you typically choose to have a portion of your salary automatically transferred into a savings or investment account. This way, the money is saved before you have a chance to spend it. Automatic transfers. Set up automated transfers from your checking account to your savings account. This can be done weekly, bi-weekly, or monthly, depending on your pay schedule. Even small, consistent transfers will add up over time. Use apps for round-ups. Many banking apps and investment platforms offer round-up features that automatically round up your purchases to the nearest dollar and transfer the change into your savings or investment account. Over time, these small amounts accumulate, helping you save without even thinking about it. By automating your savings, you remove the emotional aspect of saving. It's done for you, and you won't be tempted to spend the money on unnecessary purchases. Consistency is key, and automation ensures that you stay on track with your savings goals. The power of compound interest. One of the most powerful reasons to save regularly is the concept of compound interest. Compound interest allows your savings to grow exponentially over time. In simple terms, compound interest is the interest you earn not only on your initial savings, but also on the interest that accumulates on that savings. For example, if you save $1,000 in an account that earns 5% interest annually, after 1 year, you'll have $1.50. The next year, you'll earn 5% interest on the full $1.50. Introduction. Not just the original $1,000. This compounding effect accelerates the growth of your savings, making it a powerful tool for wealth accumulation. To take full advantage of compound interest, start saving as early as possible and remain consistent. The more time your money has to grow, the more wealth you'll accumulate in the long run. Emergency Fund. Introduction. Protecting your wealth. Before diving into complex saving and investing strategies, one of the first and most important savings goals is building an emergency fund. An emergency fund acts as a safety net to cover unexpected expenses, such as medical bills, car repairs, or sudden job loss. Without an emergency fund, you may be forced to rely on high-interest debt or loans to cover these expenses, which can hinder your ability to accumulate wealth. Experts typically recommend saving 3 to 6 months' worth of living expenses in an emergency fund. The goal is to have enough money set aside so that you're not financially crippled by unexpected setbacks. Once your emergency fund is established, you can redirect your savings toward more wealth-building strategies, such as investing or purchasing assets. Cutting unnecessary expenses to boost savings. Smart saving also involves being conscious of your spending habits and eliminating unnecessary expenses. Cutting back on frivolous spending can significantly boost your savings rate. Here are some strategies to help reduce unnecessary costs. Track your spending. Start by tracking your expenses for a month. Identify areas where you're overspending or buying things you don't really need. This will give you a clear picture of where your money is going and where you can cut back. Avoid lifestyle inflation. As your income increases, resist the urge to upgrade your lifestyle immediately. Instead of inflating your expenses with each pay raise, keep your lifestyle consistent and increase your savings and investments. This is one of the most powerful habits of wealthy individuals. Cook at home. Dining out can quickly drain your budget. By cooking at home and preparing meals in advance, you can save a significant amount of money each month. Cancel unused subscriptions. Review your subscriptions to streaming services, magazines, fitness memberships, and apps. Cancel any that you're not using or no longer need. These small expenses can add up over time. Shop smart, look for sales, use coupons, and buy in bulk for items you use regularly. Even small savings on everyday purchases can add up to big savings over time. Building wealth through strategic saving and investing. While saving alone is crucial, combining smart saving strategies with investing is the ultimate key to wealth accumulation. Saving money provides the foundation, but investing that money allows it to grow and work for you. Once you've built up a solid savings cushion and have an emergency fund in place, it's time to allocate some of your savings toward investments. Investing allows you to take advantage of compound interest, capital appreciation, and other growth opportunities, whereas saving alone generally offers minimal returns. Whether you're investing in the stock market, real estate, or other assets, always prioritize building a diverse investment portfolio that aligns with your financial goals. Staying consistent and committed, finally. Remember that wealth accumulation is a long-term process that requires consistent effort and discipline. The key to successful saving is building habits that become ingrained over time. Whether you're saving for an emergency fund, a down payment on a house, or your retirement, stay committed to your goals, even when it feels challenging. Track your progress regularly, Celebrate milestones along the way, and continue refining your saving strategies as your financial situation evolves. With time, patience, and consistency, your savings will grow into the wealth you need to achieve financial freedom. Conclusion: smart saving is the bedrock upon which wealth is built. It provides the financial foundation to secure your future and make your money work for you. By implementing effective saving strategies, automating your savings, building an emergency fund, and cutting unnecessary expenses, you create a pathway to financial freedom. Pair these strategies with investments, and you'll find that wealth accumulation becomes an attainable and sustainable goal. Remember, wealth doesn't happen overnight, but with discipline, patience, and smart saving, you'll be well on your way to achieving long-term financial success. Chapter 12: Understanding Taxes and Wealth Preservation. Understanding taxes and how they impact your wealth is essential for anyone on the journey to financial freedom. Taxes are often one of the largest expenses that individuals face, and failing to plan for them effectively can drastically hinder your ability to build and preserve wealth. This chapter will explore the key concepts related to taxes, how they affect your wealth accumulation, and strategies for preserving your wealth through tax-efficient planning. The basics of taxes and their impact on wealth. Taxes are levies imposed by the government on income, property, sales, and other financial activities. The amount of tax you pay depends on various factors, including your income level, the type of assets you hold, and where you live. Taxes can come in many forms, including federal income tax, state income tax, payroll tax, property tax, sales tax, capital gains tax, and more. For most individuals, the largest tax burden comes from income taxes. The more you earn, the higher your tax rate typically becomes, especially in progressive tax systems like that of the United States. Income taxes are often deducted automatically from your paycheck, but understanding how much you owe and how to minimize your tax liability is crucial for building wealth. In addition to income tax, taxes on investments, including capital gains tax and dividend tax, can have a significant impact on your long-term wealth accumulation. Capital gains taxes are incurred when you sell an asset, such as stocks or real estate, for a profit. These taxes can reduce the returns on your investments, making it essential to understand how to minimize or defer these taxes. In tax-efficient wealth building strategies, one of the most powerful ways to build and preserve wealth is through tax-efficient strategies. These strategies help you keep more of your money working for you instead of handing it over to the government. Here are several approaches to reduce your tax liability while still building wealth. Tax-advantaged accounts utilize retirement accounts like 401(k)s and Roth IRAs. These accounts allow you to defer taxes on contributions or even grow your investments tax-free in the case of Roth IRAs. By contributing to these accounts, you can significantly reduce your taxable income in the short term and, in some cases, eliminate taxes on your investment earnings in the long term. Traditional 401(k) and IRA contributions are made pre-tax, lowering your taxable income for the year. However, you will pay taxes on withdrawals during retirement. Roth 401(k) and IRA contributions are made with after-tax dollars, but withdrawals in retirement are tax-free, making it an excellent tool for long-term wealth preservation. Capital gains tax strategy. When you sell investments for a profit, you incur capital gains tax. Long-term capital gains, from assets held longer than a year, are taxed at a lower rate than short-term gains. By holding investments for at least 1 year, you can take advantage of lower tax rates. Moreover, tax loss harvesting allows you to offset capital gains by selling investments at a loss, which can reduce your overall tax liability. Dividend tax planning. If you receive dividends from investments, they are typically taxed. However, qualified dividends, those paid by U.S. corporations, are taxed at a lower rate than ordinary income. Investing in dividend, paying stocks, and holding them long-term can help you take advantage of favorable tax treatment. Real estate offers several tax advantages. For example, mortgage interest on a primary home or investment property may be deductible, lowering your taxable income. Additionally, real estate depreciation can offset rental income, reducing your tax liability. Real estate also benefits from favorable capital gains tax rates when you sell property after holding it for more than a year. Wealth preservation, protecting your assets from tax erosion while reducing your tax liability, is a vital part of wealth building. It's equally important to focus on wealth preservation, protecting your assets from erosion due to high taxes, inflation, and other risks. Effective wealth preservation strategies help ensure that your assets are shielded from unnecessary tax burdens and are passed down efficiently to future generations. Here are a few key strategies for preserving your wealth. Estate planning. One of the most critical aspects of wealth preservation is having an estate plan. An estate plan outlines how your assets will be distributed upon your death and ensures that they are transferred in a tax-efficient manner. Without an estate plan, your assets could be subject to high estate taxes or probate fees. Strategies like creating a revocable living trust or using irrevocable trusts can help protect your wealth and minimize taxes on the transfer of your estate. Gift and inheritance planning. You can use gift tax exemptions to pass wealth to your heirs during your lifetime without incurring significant tax penalties. The IRS allows individuals to gift a certain amount of money or assets each year without triggering a gift tax. Additionally, you can pass assets to your heirs through step-up basis, which reduces the capital gains tax liability when they sell inherited assets. Tax. Deferred growth. Certain investment accounts allow your wealth to grow without being taxed until withdrawal. Examples include 401(k)s, IRAs, and annuity accounts. These tax deferral strategies enable your wealth to grow exponentially by delaying the tax impact, especially when reinvested earnings compound over time. Asset protection. While taxes are a primary focus of wealth preservation, asset protection is also important. Asset protection involves legally shielding your wealth from lawsuits, creditors, or other financial threats. Strategies may include setting up limited liability companies, LLCs, using trusts, or purchasing insurance to protect your home, business, and other assets from claims. Inflation protection. Inflation erodes the purchasing power of your wealth over time. To protect against inflation, it's essential to invest in assets that tend to perform well during inflationary periods, such as real estate, commodities, and stocks. Additionally, Treasury inflation, protected securities, the TIPs, are government-backed bonds designed to protect against inflation by adjusting the principal value based on changes in the Consumer Price Index, CPI. The role of professional advice as you progress in your wealth-building journey. Navigating the complexities of taxes and wealth preservation can become increasingly difficult. That's why it's important to seek professional advice from tax experts, financial planners, and estate attorneys who can help you develop personalized strategies tailored to your financial goals. Tax laws are constantly changing, and staying up to date on the latest regulations can save you a significant amount of money in the long run. A qualified financial advisor can help you identify the best tax-saving strategies, provide insights into investment opportunities, and guide you through the intricacies of wealth preservation. Conclusion. Taxes are an inevitable part of life, but they don't have to hinder your wealth building efforts. By understanding the impact of taxes on your finances and implementing tax-efficient strategies, you can maximize your wealth accumulation. Wealth preservation is equally important, as it ensures that the assets you've worked hard to build are protected from unnecessary taxes, inflation, and external risks. Combining these two elements creates a comprehensive approach to long-term financial success and ensures that your wealth not only grows, but is also preserved for future generations. Remember, taxes don't have to be a burden. They can be managed effectively with the right strategies, empowering you to achieve financial freedom and protect the legacy you've worked hard to build. Chapter 13. True. Real estate as a path to wealth. Real estate has long been regarded as one of the most reliable and effective vehicles for wealth accumulation. Unlike other investments, real estate offers a unique combination of potential for steady cash flow, long-term appreciation, and tax advantages. For those looking to achieve financial freedom, real estate is often an essential piece of the puzzle. This chapter will explore why real estate is such a powerful path to wealth, the different types of real estate investments, and strategies for success in the real estate market. Why real estate is a powerful wealth building tool. Real estate has proven to be a lucrative asset class for building and preserving wealth for generations. The primary reasons why real estate is so effective in wealth building include appreciation. Over time, real estate tends to appreciate in value, meaning that the property you purchase today is likely to be worth more in the future. While short-term market fluctuations can occur, real estate historically increases in value over the long term, making it an excellent hedge against inflation. Cash flow. Rental properties provide consistent cash flow, especially if they are properly managed. Whether you own residential properties, commercial properties, or vacation rentals, rental income can provide a steady stream of revenue that covers your mortgage payments and generates profits. Leverage. One of the most powerful aspects of real estate investing is the ability to leverage other people's money. Instead of paying the full price of a property up front, you can take out a mortgage and only need to put down a fraction of the property's value. Over time, you build equity as the property appreciates, and as you pay down the mortgage. Tax advantages. Real estate investments offer several tax advantages, such as deductions for mortgage interest, property taxes, insurance, maintenance costs, and depreciation. These tax benefits can significantly reduce the amount of income tax you pay, improving the overall profitability of your real estate investments. Diversification. Real estate allows you to diversify your investment portfolio beyond traditional assets like stocks and bonds. Having a mix of investments helps spread risk, making your wealth more resilient to economic downturns in other sectors. Forced appreciation. Unlike stocks, which you can only hope to see appreciate based on the market, real estate allows you to force appreciation through strategic improvements to the property. Renovations, upgrades, and improving the property's overall condition can lead to higher property values and rental income, offering direct control over your investment's growth. Different types of real estate investments. Real estate offers a wide range of investment opportunities, each with its own risk profile and potential for returns. Below are some of the most common types of real estate investments. Residential properties. These include single-family homes, townhouses, condominiums, and multi-family units. Residential properties are the most common form of real estate investment and offer the potential for both appreciation and cash flow through rental income. They are relatively easy to understand, and the demand for housing is generally stable. Commercial real estate. Commercial properties include office buildings, retail spaces, industrial properties, and other non-residential buildings. These properties often require larger investments, but can offer higher returns through long-term leases and larger tenants. Commercial real estate can be more complex to manage, but offers more stable, long-term income potential. Vacation rentals. With the rise of platforms like Airbnb and Vrbo, vacation rentals have become a popular way to invest in real estate. Vacation properties can generate higher rental income than traditional long-term rentals, especially in tourist-heavy locations. However, they also come with unique challenges, such as fluctuating demand, property management, and seasonal pricing. Real estate investment trusts, REITs. If you prefer a more hands-off approach to real estate investing, REITs allow you to invest in real estate without directly owning property. REITs are companies that own, operate, or finance income-producing real estate. They are traded on major stock exchanges, providing a liquid way to invest in real estate while benefiting from the dividends generated by the properties they own. Raw land. Investing in undeveloped land can be a long-term investment strategy. Raw land offers the potential for appreciation over time as surrounding areas develop, but it typically doesn't generate income until you either sell the land or develop it. Land investments may require more patience and capital, but can yield substantial returns when the right opportunities arise. Fix and flip properties. This strategy involves buying distressed properties, renovating them, and selling them for a profit. Fix and flip properties can generate significant returns if done correctly, but they require a keen understanding of the market, renovation costs, and the ability to manage projects effectively. This investment style is more active and can carry higher risks, but offers high reward potential. Real estate investment strategies for success. To maximize your success in real estate investing, it's important to adopt the right strategies. Here are some key strategies to help you get started and grow your real estate portfolio. Buy and hold strategy. This long-term strategy involves purchasing properties and holding onto them for several years. The goal is to benefit from both appreciation and rental income. Over time, the property's value may increase, and the rental income can help you build equity. The buy and hold strategy is a more passive way to invest, but it requires patience and careful property selection. Cash flow focus. When selecting properties to invest in, focusing on cash flow is crucial. The goal is to buy properties that will generate enough rental income to cover your expenses and generate a profit. Positive cash flow allows you to pay down the mortgage, cover repairs and maintenance, and even reinvest in additional properties. House hacking. House hacking involves purchasing a property with multiple units, such as a duplex, triplex, or fourplex, and living in one unit while renting out the others. This allows you to generate rental income that covers your mortgage payments, living for free, and building equity in the property. House hacking is an excellent strategy for new investors who want to get started with minimal upfront costs. Real estate syndication. Real estate syndication allows you to pool funds with other investors to purchase larger properties that would be difficult to afford individually. In exchange for your investment, you receive a share of the profits. Syndications are a great way to invest in commercial properties or large multifamily buildings without needing to manage the properties yourself. Leverage local market knowledge. Successful real estate investors often focus on local markets they know well. By understanding local market trends, property values, and rental demand, you can make better investment decisions and identify the most profitable opportunities. Staying informed about your local market gives you a competitive advantage and helps you avoid potential pitfalls. Mitigating risks in real estate. Like any investment, real estate comes with risks. However, these risks can be minimized with proper planning and due diligence. Here are some ways to reduce risk when investing in real estate. Thorough property analysis. Before purchasing a property, conduct thorough due diligence, including property inspections, market research, and financial analysis. Assess potential repairs or renovations, property taxes, and rental income projections to ensure the property aligns with your financial goals. Diversification. Don't put all your eggs in one basket. Diversify your real estate investments across different property types, locations, and investment strategies. This can help reduce your exposure to market downturns or property-specific issues. Property management. Whether you manage the property yourself or hire a professional property management company, effective management is essential for maintaining your investment's value and profitability. A well-managed property is more likely to attract high-quality tenants and minimize vacancies. Insurance. Protect your investment with comprehensive property insurance. This can help safeguard your property against risks such as fire, theft, natural disasters, or tenant damage. Additionally, landlord insurance offers coverage for rental properties, including liability protection. Conclusion: real estate remains one of the most tried and true paths to wealth. With its potential for appreciation, cash flow, tax advantages, and leverage, real estate provides a unique opportunity for building long-term wealth. By choosing the right investment strategy, mitigating risks, and staying disciplined, you can build a robust real estate portfolio that generates ongoing income and appreciation. Whether you're just starting out or looking to scale your investments, real estate is an essential component of a well-rounded wealth-building strategy. Chapter 14 Tree. Designing your financial freedom plan. Designing a financial freedom plan is one of the most critical steps in achieving lasting wealth and independence. It's not enough to simply earn money. You must have a roadmap that aligns your income, savings, investments, and spending with your ultimate goal, financial freedom. A well-designed financial plan provides structure, clarity, and focus, ensuring that every decision you make brings you closer to your financial goals. In this chapter, we will explore the key steps to creating a comprehensive financial freedom plan that will set you on the path to achieving your desired financial future. Step 1. Define your vision of financial freedom. Before you can create a plan, it's essential to define what financial freedom means to you. Financial freedom is not a one-size-fits-all concept. It varies from person to person. For some, it may mean retiring early and traveling the world. For others, it might involve being debt-free, owning a home, or having the ability to work on passion projects without worrying about money. Take time to visualize what your ideal life looks like. What would you do if you didn't have to work for a paycheck? This vision will serve as the foundation for your financial freedom plan, guiding all your decisions. Step 2. Set clear financial goals. Once you have a clear vision of your financial freedom, the next step is to set specific, measurable, achievable, relevant, and time-bound financial goals. These goals will serve as milestones along your journey to financial freedom. For example, your goals might include saving a certain amount for retirement, paying off debt, or building an investment portfolio worth a specific amount. Break your long-term goals down into smaller, actionable steps. Setting short-term, medium-term, and long-term goals will help you track your progress and make adjustments when needed. Step 3. Assess your current financial situation. Before you can move forward, it's important to take an honest look at where you currently stand financially. Assessing your income, expenses, assets, and liabilities will give you a clear picture of your financial health. Review your bank accounts, debts, investments, and monthly expenses to determine where you are. Are you saving enough? Are you carrying high-interest debt? How much of your income is being spent versus saved or invested? This assessment will help you identify areas where you can improve and make adjustments to align your financial situation with your goals. Step 4. Create a budget that supports your goals One of the most important aspects of a financial freedom plan is creating a budget that supports your financial goals. A budget is a tool that helps you track and control your spending while ensuring that you allocate enough money towards savings and investments. Start by categorizing your expenses. Fixed costs like rent, utilities, and insurance, as well as variable costs like food, entertainment, and travel. Once you have a clear understanding of your spending habits, prioritize savings and debt repayment in your budget. Look for areas where you can cut back or adjust your lifestyle to save more for your financial future. Remember, a budget is a living document. It should be reviewed regularly and adjusted as your financial situation changes. The goal is to consistently put money toward your long wealth, term-building efforts without compromising your immediate financial well-being. Step 5. Eliminate debt strategically. Debt can be a major obstacle on your path to financial freedom. So one of the key components of your plan will be developing a strategy for paying it off. Start by focusing on high-interest debt, such as credit card balances, as it tends to grow quickly and can drain your finances. Once high-interest debt is cleared, focus on paying off any other liabilities, like student loans, personal loans, and mortgages, according to the interest rate and balance. There are several strategies for tackling debt, such as the debt avalanche method, paying off high-interest debts first, or the debt snowball method, of paying off smaller debts first for momentum. Whichever method you choose, the goal is to eliminate debt as quickly as possible to free up more resources for savings and investments. Step 6. Build an emergency fund. An emergency fund is a crucial part of your financial freedom plan. It acts as a safety net, protecting you from unexpected financial setbacks, such as medical bills, car repairs, or job loss. The ideal emergency fund should cover 3 to 6 months' worth of living expenses, ensuring that you have a cushion to fall back on in case of emergencies. Having an emergency fund in place prevents you from having to rely on credit cards or loans when life throws you a curveball, allowing you to stay on track with your financial goals. Step 7. Develop a wealth building strategy. Wealth building is the key to achieving financial freedom, and it requires a disciplined approach to saving, investing, and growing your money. Identify the most effective wealth building strategies for your situation, such as investing in stocks and bonds. Building a diversified investment portfolio can provide long-term growth. Consider low-cost index funds, mutual funds, or individual stocks based on your risk tolerance and financial goals. Real estate investments, as discussed in Chapter 13. Real estate can be an excellent way to build wealth. Whether you're investing in rental properties or flipping homes, real estate can generate passive income and appreciation over time. Entrepreneurship. If you have a passion or skill, starting a business can be a great way to build wealth and achieve financial independence. Entrepreneurship requires risk, but it also offers the potential for high returns and personal fulfillment. Passive income streams. Focus on creating passive income sources, such as dividends, rental income, or royalties, which will allow your money to work for you, even when you're not actively working. The key is to start investing as early as possible and to stay consistent with your contributions, allowing the power of compound interest to accelerate your wealth-building efforts. Step 8. Monitor and adjust your plan regularly. Your financial freedom plan should be a dynamic document, reviewed and adjusted regularly to ensure that you're on track to reach your goals. Life circumstances change, and so will your financial situation. Be prepared to adjust your savings rate, investment strategy, and goals as needed. Regularly monitoring your progress helps you stay focused, overcome obstacles, and make the necessary changes to stay on the path to financial freedom. Step 9. Protect your wealth as you build wealth. It's important to protect your assets from potential risks. This includes getting the right insurance coverage, health, life, disability, and property insurance, and setting up an estate plan to ensure that your wealth is passed down to your loved ones according to your wishes. Proper asset protection prevents unexpected events from derailing your financial progress and ensures that your wealth can continue to grow over time. Conclusion: designing a financial freedom plan is an essential step in creating a secure and prosperous future. By defining your goals, assessing your current situation, eliminating debt, building an emergency fund, and focusing on wealth building strategies, you can achieve the financial independence you desire. Remember, financial freedom is a journey, not a destination. Stay committed to your plan, monitor your progress, and adjust as necessary, and you will eventually find yourself living a life of financial freedom, free from the constraints of money and empowered to live life on your own terms. Conclusion: achieving financial freedom is a transformative journey, one that requires dedication, discipline, and a clear plan of action. Throughout this book, we have explored the fundamental principles of wealth building, from developing the right mindset and financial education to creating multiple streams of income and making smart investments. By mastering budgeting, controlling expenses, managing debt, and understanding the role of passive income, you are equipped with the tools to take control of your financial destiny. Designing your financial freedom plan is not a one-time effort, but a continuous process of refining your approach, staying committed to your goals, and adjusting your strategies as life evolves. Whether it's through investing in real estate, leveraging entrepreneurship, or creating a diversified portfolio of assets, the path to financial independence is within reach for anyone willing to take consistent, intentional steps toward it. The power to build wealth and achieve financial freedom lies in your hands. You have the knowledge, the strategies, and the mindset to create lasting wealth. And with each decision you make, you are moving closer to the life you envision. Financial freedom isn't just about accumulating money. It's about gaining the time, flexibility, and peace of mind to live life on your terms, pursue your passions, and leave a lasting legacy. As you embark on this journey, remember that progress is made through consistent action. It won't happen overnight, but with persistence, focus, and a commitment to your plan, financial freedom is not just a dream. It's an achievable reality. Take the lessons you've learned from this book, put them into practice, and start building the financial future you deserve. Your journey to financial freedom starts now.